everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today, we're going to look at the monthly moving averages for the IB portfolio and the S&P 500. The IB portfolio is an equally weighted portfolio constructed with 5 ETFs that feature a mix of different asset classes, including domestic and international stocks, bonds, real estate, and commodities. For each fund within the portfolio, I compute a moving average of the monthly closing prices over the past 10 months. If the fund closes out the month below the level of its moving average, the signal is to sell and hold cash. If it closes above, the signal is to invest. This approach requires monthly attention, which is why I update it monthly on the Advisor Perspectives website after the close of the last business day of the month. Now that March has ended, we can look at the updated signals for each of the 5 ETFs that make up the IB portfolio. At the end of March, one of the 5 ETFs closed below its 10-month moving average, the Vanguard Total Stock Market ETF, VTI. So the position would be to sell and hold cash for this ETF, but to invest in the other 4. Also shown is the percent of how far each fund is from their moving average. The positions that are less than 2% are in yellow to highlight those that are close to reversing positions, like the iShares 7 to 10 year Treasury Bond ETF, IEF, and the Vanguard Real Estate ETF, VNQ. You can see VNQ is just 0.1% above its 10-month moving average, so it's very close to reversing to a cash position. Now for a slightly different view, we've replicated this process but used monthly closes for the past 12 months instead of 10. By lengthening our time frame, the moving averages have become slightly less volatile. Again, we can see that at the end of March, VTI is the only fund in a cash position. However, notice the shift in variance compared to our previous table. VTI was 2.6% below its 10-month moving average, but is only 0.8% below its 12 months. Additionally, those funds that were highlighted yellow on our 10-month table are now green. And one last thing to point out is that the Invesco Commodity Index Tracking Fund, DBC, has actually moved closer to its moving average when we look at the 12 months compared to 10. Now let's take a look at the broader market. The S&P 500 closed out March with a monthly loss of 5.5%, its largest since December 2022. But let's examine the market through the lens of moving averages. To reiterate, we're looking at the index's close on the last day of each month, not the index's monthly average of closes, and calculating a moving average based on the prior 10 months. So if the close for March 31st is above the moving average, then we hold. If it closes below, then we move to cash. At the end of March, the index closed 2.6% below its 10-month moving average, marking its first cash position since October 2023 and the largest negative variance since December 2022. Here's the same chart, but this time using a 12-month simple moving average. At the end of March, the index closed 0.9% below its 12-month moving average, so the position is to sell and hold cash. Again, this marks the first cash signal since October 2023, and the largest negative variance since December 2022. As we can see, the 12-month moving average is just as, if not more, effective than the 10-month in reducing losses. Now, our last variation to this strategy uses the 10-month exponential moving average, which is a slight variant to the simple approach we've used in the previous 2 charts. In this version, I've mathematically increased the weighting of newer data in the 10-month sequence. Similar to our previous methods, at the end of March, the position is to sell and hold cash. The index closed 1.3% below its 10-month exponential moving average, once again marking the first cash signal since October 2023 and the largest negative variance since December 2022. To summarize, for the first time in nearly 1.5 years, all 3 approaches flashed a sell and hold cash position at the end of March. Could this be a temporary blip? After all, the cash position from October 2023 was just a one-off. Or is this the start of a deeper downturn? Only time will tell, but I will definitely be watching closely. And to close out, I just want to point out that my S&P 500 illustrations serve as examples, not trading signals. I use this index because of its extensive historical data, but moving average strategies should be applied to individual investments, not a broad index. Even funds tracking the S&P 500, like SPY, may generate different signals due to dividend reinvestment, which my illustrations exclude. And that's all for our March Moving Averages update. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.